What is up, world? It's your boy Ton, and you are listening to the Wonton Wealth Podcast. Here, I'm going to unravel anything and everything commercial real estate related. And more importantly, we're going to add abundant value. So if you're ready, buckle up your eardrums. Last week, I hit you with 3 important terms that you should know. So this week, I'm going to hit you with 3 more. We're going to be talking about recourse and non-recourse loans, rate lock deposits, and forbearance. So first up, we have recourse. What does that word even mean? In simple terms, recourse means that a lender can come after you personally if you default on a loan. And non-recourse means they can't do that. Typically in commercial real estate, you're not going to see many non-recourse loans. Typically, they're all going to be recourse. This means that the bank's going to have the power to pursue your personal assets if there's a foreclosure. Meaning if you fuck up, they're going to come after your shit. It's like the lenders have a golden ticket pretty much to your personal treasure chest. And once again, in a non-recourse loan, you don't have to worry about that. That's why all the multifamily guys come out scar-free. Their personal assets are pretty much shielded and the banks really can't touch them. For banks and lenders, they're typically going to like recourse loans a little bit more because it's a little bit of an extra safety net or an insurance policy that protects their interests if things go south. Now, we're going to talk about rate lock deposits. You've probably heard of this in commercial lending, or you may not have. But picture this. You're on the verge of securing financing for your dream property, but then interest rates just start jumping up like hot popcorn. And that's obviously not going to be good for you because you've underwrote your property at a certain interest level. And now just because the bank's twiddling their thumbs or you can't close on time before the interest rate goes up, you get screwed. But this is where rate lock deposits come into play. Your smaller community banks typically don't require a rate lock deposit, so it's in your best interest to insist on locking the rate at the application stage with them. Some banks might even suggest you wait until your loan approval to see where rates go, because if you're in an environment where rates are kind of creeping up, they're going to want a higher interest rate because at the end of the day, they get more money. So in that scenario, if you wait until your loan docs are finalized, you might get a couple of gray hairs from all the stress this is giving you. When you lock in your rate early, it actually benefits both parties. You, as the borrower, will get peace of mind knowing that your interest rates won't unexpectedly rise. So then that means your underwriting is solid. And on the lender side, they're going to be reassured knowing that interest rates won't surge to a level that jeopardizes the loan before it can be locked. Because once again, if the interest rate jumps too high, that means your debt service coverage ratio will drop because your NOI is already fixed at a certain level. And then when the debt service increases, the debt service coverage ratio reciprocally drops. Now, last on our list is forbearance. Forbearance is like hitting the pause button on your mortgage payments. It's essentially an agreement between you and your lender to temporarily reduce or suspend your monthly payments for a set time. And this can be a financial lifesaver during super tough times like the recent COVID season that we just had. But remember, it doesn't mean your payments are magically going to disappear and you don't have to pay them. You're going to have to pay back what you owe, just on a different schedule. So it's either you get less of a payment and it's increased in length for the mortgage, or they just temporarily suspend all of your payments and add it to the back of your loan. So for example, if you had a loan that was 10 years and you've made a year's worth of payments, you have 9 years left, but for some reason at month 13, some economic recession hits or COVID hits again and you can't make your payments. If you ask the bank for 6 months worth of forbearance, they can either tack on that 6 months to the end of your 9 years. So now you still have 9 years and 6 months worth of payments left, or they're going to drop your payments to, let's say, half and increase the length of your 9 years at the end by another 3 months or so. Forbearance essentially offers temporary relief, but it's super important for you to understand the terms and what happens once that pause is over. It's going to be like a timeout for your wallet, but it's not a get out of debt free card. So to go into more detail, let's say you're struggling to meet your loan obligations and you need more time to either refinance or to sell your property. This is when you consider discussing a forbearance agreement with your bank or lender. It's going to give you an extension period to cure the default, usually between 3, maybe 12 months. It really depends on the bank. And it's a win-win situation because it allows you the time to get back on track and preventing that immediate foreclosure. Because if you go into foreclosure, that's going to hurt your credit score and it's going to hurt your future probability of getting favorable mortgage rates. Obviously, you don't want that. And a cool advantage of a forbearance agreement is that it won't leave a mark on your credit history or background check. But there's always a few things you got to keep in mind. First, the missed payments. You got lender's attorney fees and any related expenses that will go into repaying that forbearance time eventually. If you default on the agreement, it's going to become void, and then you're going to incur a forbearance fee and potentially you're going to go into foreclosure. Some lenders might even request additional collateral, and you can either resist, depending on your situation, or negotiate your way out of it. And there you have it. Those are 3 additional terms that are going to help you be even more of a savvy investor. These terms might seem complex, but hopefully I've generalized them enough for you to be understandable. Good luck investing. And that's a wrap. If you've made it this far, that means you've listened to the entire episode, so thank you. I hope you enjoyed it, and if you did, please leave a review on Spotify, Apple Podcasts, or wherever you're listening from. And if you've learned something or found it useful, share it with one of your homies. And if you want to get in touch with me, I'm pretty active on IG. My handle is pro_TANH. Reach out, let me know what you liked, what you didn't like, or what you want to hear about in the future. I'm here to tailor this to you. Until next time.